Hey everybody, Boris Schlossberg, and we're going to kick off our Euro course with lesson number one, the quick and dirty primer on the Euro. I'm going to try and basically give you the absolutely key critical primary points to understand about the Euro itself, how it's been constructed, what are its advantages and what are its problems, and it will very much help you, hopefully, to understand how and why it trades, and hopefully let you trade the instrument a lot better. The first and foremost thing I think you need to understand as far as the Euro goes is that it is the most liquid financial instrument in the world. Not just the most liquid currency, but literally the most liquid instrument. It is more liquid than any bond, any stock index in the world. And that is one of the reasons why so many people love to trade this instrument, because it literally trades $1 trillion a day. To give you an idea of just how vast the market for Euro is, according to just, I think, the 2013 BIS survey, it's already a couple of years old, it traded $1.3 trillion per day. The number now, if I were to pretty much extrapolate, is probably going to be around close to 1.7 as we stand here at the beginning of 2015. And effectively, 24%, fully 1/4 of all currency dealing across the world happens in this just one single currency. On the retail side, where we participate, the participation is actually much larger. It's probably around 50% of all trades are settled primarily in the euro dollar. So in that sense, it is truly something that everybody in the currency market trades, and actually almost everybody in the capital markets trades in a very active fashion. And that's what makes the euro-dollar pair such an interesting and valuable and hopefully profitable instrument to trade, as we'll teach you in this course. I just want to give you an idea at how large $1.3 trillion a day is. Today, as I'm speaking to you in this course right now, Apple is doing its Apple Watch demo, and everybody in the world is watching it, including me, and everybody is, of course, fascinated with all the brand new things that Apple is doing. But just to give you an idea of what Apple does a day in terms of trading, it has about 60 million shares a day on a regular day, and it trades at around $120 per share. So it effectively does about $7 billion turnover. Let's just, for argument's sake, say it does $10 billion turnover. Perhaps today it's going to do maybe $15 billion turnover. That's still 1/10 the size of what the euro is going to do on an average day. And today is a very, very special day for Apple, the largest company in the world. So to give you just an appreciation of just how vast, enormous, and fully participatory the market for euro dollar is, relative to the Apple even, it just boggles the mind. For us as traders, the net impact of that is that competition, the size and liquidity of the euro, makes it literally the most liquid currency with some of the tightest spreads you can possibly imagine. Generally, if you're trading with a broker that gives you raw spreads to the interbank market, such as this broker over here, you can trade euro for as little as 0.2 of a pip, which is minuscule. If you think of a pip as a basis point, then this is 1/5 of a basis point. 1/5 of 100 of 1% is the cost of the bid-ask transaction in the euro. And sometimes it's even small. Sometimes it can be 0.1, and sometimes it can be choice, where it's actually equal. So it is literally almost transaction free in terms of trading this currency, because there's so much competition and everybody is willing to make bids and asks all the time, and you can do an enormous amount of size on each side. For us as retail traders, for example, a large size of retail order would be considered to be $1 million. In the euro dollar, you could do 20 million, 25 million pretty much at these prices without really moving the market. And that's just remarkable as an instrument goes. You certainly couldn't do 25 million on Apple and not move it by a penny. And this you could move by 1/10 of 1 penny, which I think is absolutely extraordinary as far as the liquidity of the currency goes. Now, the euro dollar also trades across other currencies. I just wanted to, we're obviously going to focus on the euro dollar as the primary trade, but I also just wanted to highlight to you some of the key crosses that the euro trades against, because they're important to understand, and they're also very, very liquid, and they also have their own dynamics. The most important cross that the euro trades against is the euro-yen cross. And in many ways, that cross reflects all of the world's risk sentiment. So typically it tends to go up when stock markets go up. It tends to go down when stock markets go down, mainly because it used to, the yen has always been a zero interest rate currency. The euro used to have a yield. The things have changed dramatically lately because the euro now, of course, is also a zero interest rate currency, but it still reflects in many ways these flows of risk, probably perhaps because of its historical importance. The euro-pound cross is a very important cross because this is the two major currencies that are very liquid that trade in the European continent. And these days, as you'll see as I go forward in our presentation, the euro-pound cross is not only simply a trade between who's doing better, the European economy or the UK economy, but it's starting to become a reflection of who's safer as a potential safe harbor currency. And that's because of the potential troubles that are happening in the Eurozone, which I'm going to touch base in a little bit. So in many ways, the euro-pound cross could be something that is going to attract far more attention than its economic importance demands if it becomes a political instrument as well as an economic one. And of course, the euro against the commodity dollars, against the Aussie, the Kiwi, and the Canadian dollar, trades very actively. And what's fascinating about these particular crosses is that, first of all, they're incredibly volatile. They could move a couple hundred points a day very, very easily. And most importantly, because during the Asian session, they will very often move on Australian or New Zealand data. And then during the European and the US session, they will very often move on the US and European data. They tend to do very quick turnarounds. In other words, they tend to move one way during the one session and move the other way during the other session. This often makes the Euro Aussie, the Euro Kiwi, and the Euro CAD crosses very, very attractive to a lot of traders who like to do range trading, where they like to sell highs and buy lows, and sell session highs, buy session lows all the time. But beware, once the euro catches a trend, whether it be positive or negative, it can create a very vicious one-way market in these particular crosses. And of course, the trends are a function of the major themes that the euro can express. And within the euro, of course, the primary theme here is the inherent conflict of the currency. The underlying problem of the euro, as you can see on this particular map, which I'm going to point out, is that it's a hodgepodge of a whole bunch of very different countries that have been brought together under a unified monetary regime, but not necessarily a unified political regime. Just to give you an idea of sort of how complex the structure in Europe is, everything that's in blue is actually part of the European Monetary Union, part of the Eurozone, and all of these countries share the euro as a currency. In the middle of this all blue land, you see the white piece, which is Switzerland, which is not even part of the European currency or the European Monetary Union. It stands by itself in its own little white neutrality. Then everything that's in red is part of the European Union, but not part of the currency. And that includes, by the way, many of the many of the Baltic nations, and of course the Scandinavian nations, with the exception of Finland, which is part of the euro currency itself. And then, of course, beyond that, you have parts of Europe that are not even part of the European Monetary Union. So you have these sort of levels of unification. And even the most intense level of unification, the level that says we're all going to share the currency, still doesn't provide the kind of unification that we have in the United States of America, where we have a central government that sets policy for all the states, that stands supreme. This is the critical thing, that stands supreme over state government. We don't have any institution, with one exception, which I'm going to talk about later on in this presentation, that is supreme to every one of these governments. So effectively, you have all of these governments who have joined in a single currency, but each one of them decide their own political fate independently. And that, of course, creates massive amount of potential conflict, as we'll see in just a second. When you look at the Eurozone, basically, the simplest, easiest, and probably the most effective way to understand it is that it's Germany versus everyone else. From an economic point of view, that's certainly very, very true. Germany is such a massive, dominant factor in the Eurozone as far as an economic player. It pretty much sets the policy for everybody else. Just to give you an idea of how powerful Germany is, it is the third largest exporter in the world. So it's a relatively small country geographically. I don't think it's bigger than the size of Wisconsin in the United States of America, but it exports 2 trillion euros of products across the world. It is so massively well developed. It produces such great manufacturing base. We all know all of the German products that everybody loves across the world, and that as a result of it, it actually is responsible for, I believe, 25% of all European GDP. It's certainly the biggest economy in Europe. And because of that, and because of its economic power, it effectively sets the policy for everybody else. It has a de facto veto vote for how people should act. And because Germany is so much more efficient, and because Germany is so much better prepared to transact in a global economy, it tends to have far less problems than other members of the European Union, and therefore requires far less help. And this inner conflict between how well Germany is doing and the rest of the European countries is really what is creating the underlying conflict within the euro itself. Now, the reason, by the way, why Germany is so incredibly afraid of spending money is because it has this terrible national historical memory of hyperinflation. The episode of hyperinflation that happened in Germany has literally never been repeated anywhere, with the exception maybe of Zimbabwe, but certainly nowhere in the European continent or in the Western world have we seen the kind of hyperinflation that occurred in Germany in the early 1920s after World War I, where a single Deutschmark, where one loaf of bread, a single Deutschmark would buy a loaf of bread, and then it went to 200 trillion Deutschmarks. I don't even know the amount of money. Literally, wheelbarrows of money were needed to be printed to buy a single loaf of bread. All sense of what we think of as value disappeared. And although it was a very, very long time ago, the German culture still remains incredibly antithetical and incredibly opposed to any type of debt and any kind of inflationary stimulus, which is why the Germans tend to be much more frugal and impose a much more frugal regime on everybody else. Now, if everybody in European theater was as frugal and effective as Germans, it wouldn't be a problem. But as you can see, the situation in Europe is heavily varied. This is an example, by the way, of the Greek GDP, which has been the single biggest problem for the European Monetary Union as a member. And you see that Greece effectively, since 2007, went from, I believe, a small amount of debt to GDP to literally 177% of debt to GDP ratio. And at levels like this, every single intelligent economist, every single analyst will tell you that it is impossible for Greece to literally pay back this money. It's also impossible for Greece to pay back this money, given the fact that over the last 5 years, since it's seen its debt ratio explode to this level, its actual economy has contracted by 1/3, by 30%. So you have this dual toxic combination of absolutely no way to create revenue and huge debts that are mushrooming. Now, this wouldn't be a problem if the European Union was fully integrated into a national single government. Because in the United States of America, for example, we have many states that harbor the same kind of very negative balances. But we have the ability to use one state's excess revenue to pay for other states' debts. So Connecticut, for example, pays for Mississippi, and if California pays for a million of other states' debts, and all of the money is distributed. But in Europe, you don't have this kind of fluidity, and that has created effectively the Eurozone crisis, which on and off simmers up and down, up and down, up and down continuously. It sort of always is underground. It occasionally blows up into a major political issue, but it almost never goes away. And the reason why it doesn't go away is because the mathematics of the European crisis literally just have not been resolved. If you look at this chart here, what you see is that debt as percentage of GDP across the major European economies is well above what most economies consider to be a safety level of 100%. Once the debt of GDP ratio goes above 100%, it puts a country in essentially a big danger zone, because at that point, it becomes less and less possible for it to repay its debt out of the revenues and earnings of its GDP. In this particular case, of course, Greece is a complete basket case at 165% debt to GDP, and almost no one thinks that they will ever pay anything back. But what's more troubling, I think, is the fact that you have a couple of other members, and most importantly, and this is really the most important part, Italy. Italy, which is the third largest economy in Europe. It goes Germany, France, Italy. And Italy, at 121% of debt to GDP, of course, is a far greater danger to the Eurozone fracture idea than anything that Greece can do. If Greece were to leave the Eurozone tomorrow, almost no one really would care. It would cause probably a short-term recession within the Eurozone. It could cause some serious write-offs. But ultimately, Europe could easily absorb it. Greece is only 2% of the gross GDP of the Eurozone, and as such, really is a minor player. But the problem is that if Greece were to either be expelled or simply leave the Eurozone, it would then open the door for speculators to begin to make a run against other vulnerable nations. And in this case, Italy stands the most vulnerable of all, because Italian GDP has also been very lackluster, has not been growing, has not been able to stimulate. In fact, has been in a deflationary spiral for a very long time. And it's quite easy for speculators, once they see there's a green light to go after the sovereign debt of these nations, to begin to pile in and try to destroy the Italian sovereign debt. Now, if Italy were to come under assault, that creates a completely different story, because the third largest economy out of the Eurozone being forced out of the Eurozone effectively destroys the Euro as a trading instrument. And that is the true danger of this. It's sort of the story with the Euro is it's only as strong as its weakest link. And at this point, of course, as we're starting now in 2015, its weakest link is irreparable unless the other parties in the European Union are willing to effectively bail it out. And that is something that is definitely not happening. Now, the key to understanding the euro, as I said, is that it's a single currency but separate governments. And what that means is that the European Central Bank, by that definition and by the construct of how the European theater is constructed, is the single most important institution in Europe, simply because it is the only source of central power in Europe. But unfortunately, when the ECB was chartered, it was chartered with a very limited mandate. Its mandate was, because of course it was primarily chartered by the Germans, its primary mandate was only to control inflation rather than stimulate growth. One of the key differences when you're examining the euro-dollar pair and you contrast what the ECB must do and what the Fed is mandated to do is that the ECB must only focus itself, according to its charter, on inflation, whereas the Fed is tasked with both, making sure that the economy grows, therefore it's tasked with the idea of stimulating jobs and controlling inflation. So it has a dual mandate, whereas the ECB has a single mandate and therefore is limited in its policy choices. But despite the fact that it's limited, because it is the single most powerful institution within the Eurozone, it has taken charge and has taken leadership in trying to stimulate the Eurozone economy and preserve the euro and grow the Eurozone economy and strengthen the economy for all of its members. Mario Draghi, who happens to be Italian, of course, and who is, I am sure, keenly aware of the need to stimulate and make sure that all of the members in the European Union begin to grow, because otherwise the threat of Italy leaving the Eurozone becomes far greater, has actually moved the ECB to a much more stimulative path and forced the central bank to enact a QE program, much to the objections of the Germans. He did this in a very, very clever way. He basically said, well, we're mandated to keep inflation at 2%. And because the situation in Europe is so dire, it's actually in a deflationary state, we need to spend money to bring it up to the 2% mandate. He's sort of using the mandate as a way to stimulate the European economy. Whether this works or not remains to be seen. And I think the greatest impact that the policy has had on the euro is it's actually had the greatest impact on the currency itself, as the currency has really come down in value. But the much greater and the much bigger factor, I think, in determining the future of the euro is a political one rather than an economic one. Economically, the Eurozone economies have integrated themselves quite well. As a matter of fact, you could make an incredibly valid argument that the Eurozone is far better off under a single monetary currency regime than it's ever been before, because the cost of transactions has gone away. In other words, you used to have to, if you wanted to buy something from Germany and transport it over to Italy, you'd have to change from Deutschmarks to Lira, and then if you had to move those over to France, you'd have to change them to francs, and then if you had to move them over into Spain, you have to change them to pesetas. And you can imagine that at every single point of transaction, somebody took a piece of a transaction out. Very inefficient, highly bureaucratic, and generally the opposite of what we would call friction-free markets. So the fact that you can now buy and sell anything and everything over this vast land of more than 500 million people and a large economy that in gross is actually larger than the U.S. economy, has been a huge, huge help. But the problem with the euro, when you examine it from a larger point of view, and the key thing to understand it, is that it's not an economic issue, but it is a political one. Because within a broad-based economy with lots of different actors, you're always going to have some who are doing much better and some who are doing much worse. The much bigger question for Europe, and the much bigger question whether the euro is going to remain a single currency, is whether they come close to this idea of a super state, the idea of sharing of burdens, the idea of sharing of economic wealth across the full region, or whether they're going to let their own political prejudices dominate, which inevitably will lead to a breakup. That is the quick and dirty primer on understanding everything you really need to understand about how the euro works in the current market environment.